Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have our two standard but non-standard guests this morning. First of all, we have Canadian Graham, and we have Gaurav, who is here to talk about Australian marsupials.
I think I know who's standard and who's not standard, by the way. I don't think your code was lost on me.
It's debatable.
Okay, I've just got a little bit of playtime. I'm going to hit you with some numbers, and then you can tell me what they relate to. First of all, one for Gaurav. I know he'll love this. It is 18 miles between New York's Pennsylvania Station and the MetLife Stadium in New Jersey. How much do you think New Jersey Transit are charging for that trip in June and July?
Okay, 18 miles. We're talking. How many kilometres is that?
Call it 26.
All right, so decent.
26 Ks,
decent
28
journey.
Ks.
$35?
It normally costs $12.90.
Yeah.
But for the period of the FIFA Club World, for the period of the World Cup, it's going to cost $100.
Whoa.
Just emphasising what a rip-off shambles FIFA is. One of the most poorly governed organisations in the world. Corporate governance is a phrase that they have not heard before. It makes MinRes look like a complete clean skin, a paragon of virtue. FIFA, you are absolutely useless. Graham, one for you.
Please don't let it be a FIFA question.
Come on, I know you two love football. Right? This is why I chose
This just puts me to shame.
Huge sports fans. All right, what is the current price to sales ratio of Google at the moment?
Oh, okay, something different. Price to sales. That's interesting.
I know.
Oh,
this
boy.
is forward.
Okay, we're talking trillions versus billions. So I'm guessing 5. I don't know. Where are we?
It's 9.
9.
The current price to sales, not the forward. Sorry, the current price to sales is 9, as it is for Apple. What do you think the price to sales ratio is the forthcoming float of SpaceX? What do you think it will be?
Well, there's a big crazy factor in that.
It's got to be
so
triple
probably
figures.
100 times. Yeah,
Not far
maybe
off,
even more.
125 times sales. And Nvidia's at 20 times sales.
Musk is, for all of his faults, he is a very good marketer of just his brand.
Absolutely, yeah.
There's got to be
Which he
no
then
more key man
destroys
risk
by,
in the world. Yeah.
Yeah. And when that floats, he will have, if you look at his wealth as a percentage of GDP, it will be about 3.6% of total US GDP, which is more than twice what John Rockefeller had 100 years ago.
Wow.
Absolutely
Pretty scary.
Astonishing. Assume SpaceX lists at $2 trillion. Okay, incredible figures. So let's return to the subject that people really want to know about, which is marsupials. Gaurav, on Monday, you wrote up an ideas lab on a company called Koala, which does those kind of mattress and sofa beds in a box things, which to me doesn't sound in any way innovative anymore. But you were quite enthusiastic about it. We don't normally look at IPOs because they tend to be priced in a way that aren't attractive, which is why they're listing. But this one seemed to have something to it. What was it you liked about Koala?
No, that's quite right. We often look at IPOs in the background, but we would very rarely write them up, and even more rarely would we actually buy them. John, the last time we bought an IPO, and the last time I bought one personally, was Aussie Broadband's IPO, and there were very specific reasons why that was the case. So I didn't pick up Koala's prospectus expecting to see something I liked. In fact, I came to it quite late, and the reason I covered it at all was I thought it was interesting that during a time of global calamity, the share price just rocketed on the first day of listing. I thought it was very unusual share price behavior. I was wondering who the heck is buying this mattress company? And that's what I thought it was. I thought it was a mattress business. As I said in the review, there are only two things I knew about it. One, that it delivered mattresses in a cardboard box, and the other was that the former Australian cricket captain, was a major shareholder, and I counted both those pieces of information as negatives. And I was quite determined as I opened the prospectus that this would be a poor business and it would be a savage kind of review that I could have a bit of fun with. But in fact, I was impressed with it. I'm always impressed, John, when there is a business that can grow from nothing. If you go from 0 to 1, from 0 to something, is always, to me, really impressive. And this is a company that it started in 2015. Over 10 years, it has gone from 0 revenue to over $300 million in revenue. It's gone from one product to a suite of products. And geographically, it's now in 4 different markets. And in particular, the American opportunity impressed me. In the US, within 2 years, they've gone from 0 to $77 million in revenue. And all these revenue numbers are gross margins of 64 to 65%, which is a really impressive gross margin figure for a furniture business like this. It's not too far off industry leader Nick Scali, which we all can recognize as an outstanding business. So the sales momentum is really impressive. They've clearly stumbled across a product and marketing fit that works for its market. They've clearly established how to grow revenue, and they've got a way of accelerating revenue in new markets. And I thought that was all very impressive.
So what does it do differently then? Because this is not a new category. They're not doing anything new here. So how is it they've been so successful so quickly?
Look, there's no single reason for that. I think some of the things that really impressed me was just the way they're focused on their expansion. They began with a single product, which is the mattress in a box. And they were one of the originators of that product. About 10 years ago, a whole bunch of companies came out with delivered mattresses, and they all kind of happened simultaneously. Koala began selling their mattresses in 2015. I actually tried one years ago, and I thought this was a horrible product. I returned it instantly, and it wasn't a Koala mattress, but I've always had this negative vibe about these mattresses. I always think they're really poor quality, but I had to put that aside, and I think that, incidentally, that's actually one of a key trait we need to foster as investors. Separate our consumer self from our investor selves, because our tastes can be quite specific.
Right, and these products have got better over the years as well, I think.
Gone from selling that one product to now selling a handful of products, but I thought that was very interesting. I often you find when a company finds success in one category, they then utilize the brand to then grow sales in other categories. So I expected to see Koala using mattress success as a way to just white label imported Chinese furniture and just slap Koala labels all over it and grow revenue that way, right? I think we've seen that many times, and that would have been the conventional way to grow it. But instead of doing that, they used the funds from the mattress success to actually, they built out an entire design team. There's now 31 people who work in the design area for Koala. They spend $6 million a year on R&D, product development. And I thought that was really unusual. That's an unusual way to go about things. And they were very careful about introducing new products. And they claim that every new product they introduce goes through about 18 months of testing and refinement. And this is all very unusual, I think.
What's unusual is also that it must have been tried 100 times by other competitors out there. How are they able to design this stuff any better than others? Do they just have some super duper designers on hand, or?
Yeah. Well, I think when you're dealing with consumer sales here, you don't have to have the best product. Well, what you need to do is have a product that people kind of like, and then it really becomes a marketing and logistics operation as well. So you have to have marketing that resonates with people, and you have to be able to deliver and get things to people quickly and cheaply. And I was impressed that Koala, they spoke about in their prospectus how they stick to the same product for multiple generations, and over the generations they improve the product slowly. And they gave a few examples which were quite instructive, I think. They said that in the mattresses, for example, what they did was they just changed the packaging over several generations. to allow more boxes to fit into a container, so they could ship more units per container and thereby lower freight costs per mattress. And that's for a young startup, that is a remarkably mature and I thought insightful kind of amendment to make. And then they also spoke about how they used to have off-the-shelf foam, which they had to pay IP costs for. And when they got the money, instead of using off-the-shelf foam, or even better off-the-shelf foam, they just invented their own foam. And that internalized a lot of the costs. It reduced their own costs. They're able to increase gross margins because of that. So then, other things like the sofa bed, which has become a big hit, especially in the US, they made that tool-free, and they saw their return rate dramatically fall, again, lowering costs. So this is a business that has shown it can iterate, improve, and I like the determined focus you see from this company. It really shows a long-term bent. There are two founders here, and one of the founders was selling a reasonable amount of equity, but the second founder didn't sell anything into the IPO, and both of them retain 37% interest in the company post-IPO. These are all signs of a well-run business, and a business that has a plan, is thinking long-term, and is doing more than just trying to extract short-term profits, which I think a lot of IPOs, and particularly these kind of direct-to-consumer products, that's generally the aim, is just they know they have a short lifespan, and they try and extract the maximum rents they can over a short period to get rich. And this just seemed different. We go through enough companies that when something feels special, we can recognize it. And my pattern recognition engine really kicked in with Koala, and it looked like a better business than I had given it credit for.
Yeah, it really surprised me how well it's doing in the US. I think that says something that they really have hit onto some, secret sauce or something, because there's no shortage of competitors in the US, because I can even see them up here in Canada, and usually whatever's happening in Canada, there's 5 more in the US. So I think that, maybe it's something about that toolless assembly that seems like something different, but whatever's actually resonating in the US seems like it says something special for them, because there just is a lot more competition there than in Australia and elsewhere. So anyone who can grow from, what did you say, 0 to 77 million or something dollars in just 2 years, that's a pretty impressive business.
I like the learning curve as well, Graham. Doing some research on the business, they first expanded into Japan and found early success there. And then they went big into South Korea, and they found they couldn't quite crack that market, and they lost a lot of money in South Korea. So they retreated within 2 years. But then for their next expansion, they just did it differently. They learned their lesson, and that's a key thing for founders and new businesses. Failure is inevitable at some point, and if you can learn from failure, I think that's really important. Instead of going headlong into their next market, which was the UK, they only went in with 1 or 2 employees. They used only $250,000 of inventory, one product. So very slow, and started scaling slowly. And that was the same approach they used in the US. They started with one product, a low labor count, low inventory, and they just grew as the demand grew. It shows you that they can. What they're trying to do is minimize damage in case the market doesn't work, but still expose themselves to all the upside of success. And it's exactly, as a business owner, that's exactly the kind of payoff structure you want to see.
Right. Similar to Lovisa in that sense. Can I just make a few comments from a marketing perspective? Because I think it's important to think about this. If you're going to think about investing in this kind of stock, you need to understand it from a marketing perspective. Now, I want to make some comments firstly on South Korea. South Korea is the most advanced direct-to-consumer model in the world, but it's slightly different to everywhere else. A lot of people find Korea a really perplexing market to invest in. I've owned a few stocks in Korea, and I understand why it's perplexing. Nick published a story this morning on Coupang, and it explains in a way how perplexing the environment is. But in terms of direct to consumer, the way that consumers tend to discriminate is not based on the online brands, but on the platforms on which they are sold. And I think that was why it wasn't successful in Korea. You can establish an online brand through Instagram marketing, through Google, which is what Koala have done. And you can do that across the world, but it doesn't seem to work in Korea in the same way. So it depends on the platform you're on, which in the major platforms are Coupang, and I think is it Nava? I think there's a few more as well. So that the brand affiliation is to the platform, not necessarily to the products on the platform. I guess that's why it didn't work there. The second thing is that, as you alluded to, Gaurav, the direct-to-consumer model has a limited lifespan. You know, they're spending, I think it's about $50 million a year on marketing, and most of that is online advertising, and I imagine most of that goes on Instagram. And people get tired of it. It has a limited lifespan. There are only so many people looking at Instagram ads for mattresses and sofa beds, and you can overexpose yourself, and it's a very competitive market, and the way that Meta and Google work, when they see something working, they will start to increase the prices on those ads, and your marketing, your return on advertising spend, ROAS, which is important in this area, ROAS tends to decrease as time goes by. So there is a shorter runway for DTC businesses than there is in the real world. And when you get to a point where you see ROAS declining, then you need to decide whether you're going to go offshore, whether you're going to expand your product range, whether you're going to just cut back on your ad spend. And I think that this Koala is at that point. They've decided to go offshore, and they're also experimenting with a pop-up shop in Sydney at the Homemaker Centre in Moore Park. Be worth going down to have a look at that at some stage. I did have a quick look online, and it looks quite nice. It's obviously experimental, but I imagine we're going to see that. We're going to see more of that kind of experimentation as they bring the brand into the real world, because the returns online are diminishing in Australia. Not in the US, but in Australia, I imagine they've reached that point where they have to do something else. So they're expanding overseas, they're expanding the product line, they're experimenting with bricks and mortar retail. And this is a model that's followed by Warby Parker. I don't know if you know those guys. Yeah, the sunglasses, the glasses shop, which has now got 350 outlets in the US and has been very successful online brand that's gone into bricks and mortar retailing, and the omni-channel thing is a way to go. So I think that's the avenue, I guess, that Koala is taking. And lastly, just to comment on friction, you know, you need, if you're going to compete in this market, it's not just about the product. It looks as though they've got really, really good products, but they do an excellent job in removing the friction in the purchases. I wouldn't buy a mattress without lying on it, but they managed to get people to do so by offering 120-day returns, which you mentioned, Graham. And they do it in a way where you don't get too many returns. I think we had a member comment on the story on Monday. I don't know if you noticed it, about he was worried about the fact that as the business grows, the return rate might increase, which is absolutely true. Their provisions for sales, I think, for returns are about $5 million this financial year. So it's not a huge number.
And just for context, mattress sales are over $100 million a year.
Yeah. Yeah, so that's what they're at, and they do it very, very quickly. They can deliver really quickly. You get that 120-day tryout period. You can change the covers. It's a modular kind of product, so you can put it together easily. No tools required. Like, they've done everything they possibly can to make this an attractive purchase online. I just think they've done a really, really, really good job of that, and that bodes well for their bricks and mortar experience. I think you're going to find that you'll be able to go into these stores and look at all different materials that you can get to change your sofa. Maybe you could change it every season, you know, with the different colours. It's going to be quite easy to do. I think it's a really interesting business. I'm thinking about buying some stock in this.
I know the reason we haven't actually recommended it, though, John, we should say, is as an IPO, I think it's not an attractive one. There's not a single dollar of the proceeds from the IPO that's going into the business itself. So this whole IPO exercise is really a way for existing shareholders to cash out, and you're on the other side of a trade where there's informed, intelligent sellers getting out and selling you stock. I just think it's not a good deal. The sensible thing is to just wait.
But the two founders are in there, though, right?
They're still in there. Yep, that's true. But my experience with IPOs is when it's a cash out scenario, you just want to wait and just see how results go. I mean, there's a long runway here. the economics are potentially very attractive because there's not a lot of capital to spend, and it should scale very attractively. But I'm being cautious, and I understand. We like the business. I've popped it on the watch list. It's far more attractive than I thought it would be, but just the IPO thing has kept me away from it for now. But I'll certainly be looking at results and listening for them on conferences and presentations.
I'd give it a go with that 120-day return guarantee, but yeah, I think Gaurav's got it right that there's a big difference between IPOs that are doing so to raise capital to invest in their business versus doing so because the current owners think now's a good time to sell. So yeah, I think I'd be following the owners, just waiting on the side for a bit.
Okay, so that's Koala. It's not something we're recommending at the moment, but it is an interesting business. We're going to wait a little while, maybe for till a full set of accounts next year, maybe later on in the year, Gaurav, and see what that's like, and then think more seriously about it. But it's a very interesting business, and if you like to check them out, go down to the Moore Park, what do they call it? Homemaker Centre or something in Sydney, not far from the SCG. All right, we are going to talk about our final subject, which is portfolio allocation. I know there's a lot of theory around this subject matter. I don't read anything about that stuff. I find it really boring. But I have found over the years that you can really affect your returns in a massive way by going bigger or smaller on particular kinds of stocks. And I think that this is an issue that doesn't get much attention because the theory tends to dominate. You know, everybody needs between 15 and 20 stocks in their portfolio, and we should never have more than 5 or 6% in each stock. Gaurav, what's your approach to portfolio allocation? Because I think you think similarly to me about this.
Yes, that's right, John. I think we were alike on this one thing. Look,
we should go to let's come over one night and we can watch a World Cup game talking about portfolio allocation at half time.
That's probably my idea of hell. The theory is there to protect, I think, mostly advisors and to limit losses. I like you, am very suspicious of and hesitant to accept the conventional wisdom about, you have 20 stocks, 30 stocks and put, 3-4% in each one and you try and maximize your percentage returns. I think the way to make money is actually through portfolio allocation. I look back at my returns because in personal portfolios, we have the freedom to do that. In portfolios, in managed funds, you cannot put 10, 20% of your money in a stock. You just, it looks reckless. Even the committees and stuff don't let you do it. We can't go to our investment committee and tell them that we're going to put 15% of our portfolio in one stock. He says it's not going to happen. There's too many safeguards. There's too much regulation. There's too many rules. But in personal portfolios, we can, and I would argue we should be selectively taking big swings. But I think the way people take swings is incorrect. I think people take swings on stuff that can gain them the maximum percentage returns. But I think what you need to do is take swings on stuff where the risk is the lowest and where your dollar returns can be maximized. And John, I think your portfolio is it's a good example of this because we were speaking and I think your top two holdings are DBI and Woolies. And those two stocks are in my top three, and they have been for a while. And I think we both put chunky weightings into both those stocks, and our dollar returns have been exceptional, even though the percentage returns have been merely okay. And I think that there's a real lesson in that. That is the way to make outsized returns. It's by finding low risk opportunities and then taking swings at them. Minerals 260, which has been one of the highest, I think it's almost at this point 8 bagged in less than a year.
And you're a shareholder in that,
Yes.
and I was a shareholder.
Yeah,
in
let's
that.
disclose that. That's one of the fastest growing stocks. But I could only, that wasn't a stock that you put 10% of your portfolio in. I put a small percentage in, and it's grown into a big percentage. But you certainly can't. That's not the stock to take. I'm not speaking about a business like that to take a big swing. It's really stuff like DBA, like Ape at $9. Lavisa when it was back at a couple of bucks. Coal when it was $1. These are the sort of opportunities that they're super cheap. The risk is really low. The expected percentage return may not be that high, but you can actually take big chunky positions in those kind of businesses. What do you think about that? I mean, we haven't specifically talked about that idea, but what's your thought? What are your thoughts?
Graham, why don't you have a crack at that? Because I feel pretty much the same way as Gaurav. How do you feel about taking a big swing at a really good opportunity?
Well, I'm going to be very boring and agree with you both.
I thought you might be more cautious, actually.
There's a book called Fortune's Formula by William Poundstone, which I read quite a while ago. But he basically laid out the Kelly criterion, which is this mathematical formula for how you should best position things, basically. And he found that it's not the stocks he wasn't talking specifically about stocks, but it's not the opportunities with the most upside that you should be having as the largest position. It's instead that you should be focusing on the lowest risk position. So it's the less risky opportunities that should take up the biggest chunk of your portfolio.
My goodness. We were talking about the Kelly criterion the whole time and we didn't even know it.
Yeah, I was waiting to drop that name. But
I want to congratulate Graham for being the only person on this podcast who actually does some research beforehand and doesn't nip off to answer the air conditioner story.
Yeah, but I think it is I think the general principle is very sound. That there's so many biases in human psychology that make us want to bet big on the thing that looks most attractive. It's why people buy lottery tickets. But you want to bet big on the things that don't have a lot of downside, where you're very, very certain that there'll be even a small payoff, because then you won't blow yourself up. You'll always have capital to reinvest, and that allows compounding. So that's the magic formula.
So why do you think, Graham, that this isn't done more widely? Is it for the reasons that Gaurav said? Is there another reason for it?
No, I think it's because of biases. That humans love the big bet. They love the thought of going up tenfold or something like that, and they can't resist doing so or placing a bet to do so. And also, I think we underweight the downside risk when we can see a big upside. Basically, we're just not very good at. Yeah, there's some very fundamental human traits that just keep showing up in portfolio allocation. It's very hard. I fall for it as well. That when you see a great opportunity, you want to go big on it instead of asking yourself, wait a minute, let's forget about the opportunity and just see how much I'm going to put on the line here, or what are the odds of it actually failing. And even if it's a modest chance of failing, you should be way scaling back your allocation.
One thing I've done to correct for that is I now focus on dollar returns more than percentage returns. I find that a helpful hack, because an opportunity like Dalrymple Bay or Woolies, I find it much easier to think about, okay, if I put this much in, the dollar return is going to be X. And that's a way of getting my brain to overcome the bias of trying to chase the highest percentage return. But everyone needs to find their own way.
But the mental screening that you have to do beforehand is to say, well, what is the risk attached to Woolies or Dalrymple Bay in the first place?
Yes.
Yeah, I know that you've already done that. Both of those stocks are highly unlikely to go to zero. And if things go badly at Dalrymple Bay, it could fall 10 or 15 or 20%. They could do a dumb acquisition or something like that. But it's a very, very stable revenue stream, and Woolies is just not going to go anywhere.
Well, I think particularly at the prices we were buying these at, John, as well. I mean, we're talking about almost a year ago now, where DBI and Woolies were both sort of 30% lower than what they are today. Very unlikely. Yeah, I think we came to the same conclusion internally that those were very safe ideas at the time.
Right. Okay, everybody, I think that's a wrap. We're not suggesting you should go big on every stock that you own. This is very much a personal issue. And we've got, I think Gaurav and I could say that, and Graham perhaps as well, we've gone through a lot of pain to get to this conclusion that a lot of our returns are based on portfolio allocation decisions rather than stock decisions.
Absolutely.
But you do really want to do this on stocks where you feel as though they're very, very low risk. You don't want to do something, go big on a stock like Minerals 260, for example. Right?
Yeah. You know, the key to all of this, John, is the key to making money, if you can distill it all, is knowing when to break rules. And that takes a lot of judgment and a lot of experience. So yes, just keep that in mind. But I think the slavish following of rules is never going to create outperformance. It's the systematic, intelligent breaking of rules that leads to outperformance.
And Graham has brought some technical perspective to that too. We
Kelly
hadn't known that we'd
criteria.
arrived at
Jeez.
the same criteria as you described. So what's that bloke's name again, Graham?
William Poundstone was the book.
It's another woman having to write under a man's name. To get any attention. Okay. Thanks very much for your time this morning. Greg, our producer, who has struggled with carpet installers, air conditioning installers, and one of us going to the toilet halfway through the podcast. I won't reveal who. Graham, thank you for your time. Have a nice rest of your day. And you too, Gaurav. Enjoy your new cool house.